All right, let's just get right into it. Nvidia, they're the foundation of this entire AI boom, right? But what if, and this is a huge what if, the demand that shot its value into the trillions isn't totally real? What if the company is actually engineering its own demand?
And we're not talking about small numbers here. The stakes are absolutely astronomical. This whole debate is casting a shadow over potential AI deals that could be worth, get this, up to $100 billion. When you're talking about a figure that big, it makes you seriously question the sustainability of this entire AI hardware spending spree.
Exactly. And that's what this is all about today. It really forces you to ask a pretty uncomfortable question. Is this AI boom we're all living through built on a genuine, explosive need for chips? Or is there some kind of financial feedback loop at work here that's just pumping up the numbers?
Okay, so to really understand what's being alleged here, we have to talk about the actual mechanism. It's a bit of a tricky concept in the world of finance. You'll hear it called round-tripping or vendor financing, but the most common term is circular financing. And for any serious investor, hearing that term should set off some major alarm bells about a company's revenue quality.
Right, and here's the key thing you need to get. It's basically a structure where a company's investment money does a U-turn. It goes out the door as an investment in another company, and then it comes right back in the front door as revenue. This can make it look like sales are booming when, in reality, the customer is just using the seller's own cash to buy its products. So how does this actually work? What does that flow of money look like?
So this visual breaks it down perfectly. Imagine Company A, let's say a chip maker. Step 1, they invest in a partner, maybe a hot AI startup. Step 2, that startup gets a big pile of cash. Step 3, what do they do with that cash? They turn right around and place a massive order for chips from Company A. And boom, Step 4, Company A gets to book that sale as revenue. The money has made a full circle. And the big question for investors is, was that a real sale? Or was that just the company's own investment coming back home?
Okay, so let's connect this theory to what's happening right now. This isn't just some abstract idea. Critics are pointing their fingers at very specific moves by Nvidia and are drawing a straight line from their investments to their GPU sales.
Yeah, so here's the argument critics are making. They look at Nvidia's venture arm, which is basically its in-house investment fund, and they see investments in huge AI companies. We're talking about players like OpenAI, the cloud provider CoreWeave, and a bunch of others. The allegation is that this isn't just a simple investment. The claim is that this money is essentially predestined to be spent right back on Nvidia's own GPUs, creating that exact feedback loop we just walked through. It makes demand look organic when it might not be.
But, and this is a really big but, this is a multi-trillion-dollar company we're talking about, and they have a very, very different story. Nvidia hasn't been quiet about this. They have a completely different way of framing these investments, and it has nothing to do with goosing sales numbers. For them, it's about strategy.
And you can see it right here, straight from the horse's mouth. Nvidia and CEO Jensen Huang have said publicly that these investments are immaterial when you compare them to their massive revenue. Their argument is really clear. This isn't about hitting a quarterly target. They call it strategic ecosystem support. In other words, they're helping grow the very companies that will create the next wave of AI, which will, down the line, create real organic demand for their chips.
So this is where it gets tricky, because you're left with two totally different interpretations of the exact same actions. On one hand, you have the artificial demand loop theory, that this is just a clever way to guarantee sales and make the numbers look good. On the other hand, you have strategic ecosystem building, the idea that this is just smart long-term investing, the kind of thing any tech giant does to secure its future. Which one is true? Well, the answer to that really determines whether you think Nvidia's growth is real or if it's a house of cards.
And that uncertainty, that ambiguity, is exactly why Wall Street is completely torn on this. This isn't just some debate for Twitter. It has very real, very immediate impacts on the market, on everyday investors, and on the valuation of the entire AI sector, not just Nvidia.
You can see it right here in the stock's performance. Every single time one of these reports comes out or an analyst starts questioning the quality of their revenue, you see this. The price gets choppy, it gets volatile. The market absolutely hates uncertainty, and this whole debate has injected a huge dose of it into one of the most important stocks in the world.
And this chart really shows why the analysts are at war with each other. The bears, they look at this and see a ticking time bomb of valuation risk. They're saying, look, if even a little bit of this demand isn't real, If the revenue quality is shaky, then all these super optimistic projections for AI are just wrong. They think a painful correction is pretty much baked in the cake.
But the bulls, they haven't really strong comeback to that, don't they? They're basically asking, what if the market has this all wrong? They'll point out that these investments are a tiny, tiny fraction of Nvidia's total sales. They'll talk about a huge, diverse customer base and say this is just business as usual, smart, venture-style investing to plant seeds for the future.
So, okay, let's zoom out for a second, because the fallout from this goes way beyond just one company's stock. This whole debate is forcing everyone to take a hard look at the very foundation of the AI gold rush itself, the massive infrastructure build-out.
That's so true. If the market even starts to think that AI hardware demand is being artificially propped up, it changes the entire game. All of a sudden, every projection about hardware demand gets questioned. Investors are going to start demanding way more transparency about who's investing in who. And the biggest question of all, is the insane pace of AI infrastructure spending we're seeing right now even sustainable? Investor confidence for the whole sector now depends on getting a clear answer.
Which leads us to the most important question for anyone watching this. You're presented with these two completely opposite stories, and there's so much money on the line. So what do you actually pay attention to? How do you figure out what's really going on?
When it's all said and done, it comes down to one thing: figuring out where that blurry line is between a smart strategic investment and a manufactured sale. And you're not going to find the answer on a simple income statement. It means you have to do the work. You have to dig into those investment disclosures, you have to track how much revenue is coming from these specific partners, and you have to demand transparency about how a company's investment arm and its sales team are talking to each other.
And that leaves us with the final massive question. Is the financial foundation of this entire AI revolution a story of brilliant, forward-thinking strategic investing that's just making the future happen faster? Or is it a story about a hidden structural risk, where this explosive growth is being held up by financial engineering that just can't last? The answer to that question is probably going to define the next era of tech and the markets.